At the beginning of July, the share price of a company called Opendoor sat at roughly 50 cents. On July 21st, the stock price peaked at almost $5, a gain of roughly tenfold. This massive rally happened despite the fact that the company did not announce any material news during this period. The rally was largely catalyzed by one man. Eric Jackson runs a hedge fund called EMJ Capital, which is presumably named after his initials. He is very active on Twitter, and over the past few weeks he has been incessantly posting about his long position in Opendoor. His tweets include AI-generated images of Donald Trump. He says he expects Opendoor's stock price will rise to $82. Jackson has accumulated a large following of retail investors who have followed his example and piled into the stock, thus resulting in a massive increase in trading volume and share price. Opendoor went public in 2020. It merged with a SPAC run by the infamous stock promoter Chamath Palihapitiya. Opendoor is a so-called iBuyer. They run an internet-based platform where they give instant cash offers to buy your house from you. They then try to flip the house, selling it to someone else for a higher price. The iBuying business model has been largely discredited. In 2021 and 2022, the real estate tech companies Zillow and Redfin shut down their iBuying operations after incurring large financial losses. Opendoor itself has incurred operating losses since inception. In 2024 alone, Opendoor incurred an operating loss of $320 million. Investors became increasingly skeptical of Opendoor's viability, causing a precipitous decline in the company's share price. The trading price of Opendoor's common stock declined by 95% until the recent rally catalyzed by Eric Jackson. In this video, we'll analyze Opendoor's operational performance, why Eric Jackson is bullish on the company, and how he created a meme rally. Opendoor operates an online platform where they buy and sell homes. If you want to sell your home, you just type in your address and some basic information. They'll give you an offer almost immediately. The main selling point for homeowners is that they can get an offer and close a sale very quickly. Trying to sell your house with a traditional realtor can take weeks or even months. Opendoor charges a service fee of 5% plus closing fees of approximately 2.5%, so the total fees they charge is slightly higher than the fees charged by a traditional realtor. In addition to the service fees, Opendoor also tries to sell each home for a higher price than they bought it. They call the difference between the buying and selling price the spread. To maximize the spread, Opendoor often gives lowball offers. For example, this Reddit user received a $725,000 initial offer from Opendoor for his home. Opendoor later revised the offer down to $658,000. He reached out to a local realtor who said the house should be listed for $750,000. He went with the realtor and ended up selling the house for $800,000. By using a realtor, this Reddit user received $142,000 more than Opendoor would pay him. In the most recent quarter, Opendoor sold 2,946 homes and generated $1.15 billion of revenue. So their average selling price was $391,400. Their cost of revenue was $357,800 per home. This includes the purchase price as well as any repairs or maintenance they had to do. So they made a gross profit of $33,600 per home. That sounds pretty good. But despite making such a large markup on each house sold, the company incurred an operating loss of $56 million and a net loss of $85 million in that quarter. So why is this the case? When Opendoor buys a house, they list it for sale, but it doesn't sell immediately. In the first quarter of 2025, they sold 2,946 homes, and they ended the quarter with 7,080 homes in inventory. Their inventory is 7 months worth of sales, which indicates that after they buy a house, it takes approximately 7 months to sell it. In the meantime, Opendoor is responsible to pay property taxes, HOA fees, yard maintenance, etc. Also, Opendoor borrows money to fund the purchase of the home in the first place. So while they're waiting for the home to sell, they accrue interest expense. So let's go back to the unit economics. They make a gross profit of $33,600 for each home they sell. They incurred direct selling costs of approximately $9,800 per home. This includes things like broker commissions, external title and escrow related fees, and transfer taxes. While Opendoor usually buys houses directly from homeowners, they sometimes buy them through third-party real estate agents. That's why there are broker commissions. Opendoor incurred holding costs of approximately $5,800 for each house. This is mostly property taxes and HOA fees. And finally, they incurred interest expense of $9,800 per house. This interest is only from the debt they borrowed specifically to purchase houses. Opendoor also has some corporate level debt which isn't included here. After subtracting these expenses, Opendoor's profit per house declines to just $8,200, giving them a contribution margin of just 2%. As an aside, Opendoor reports its contribution profit before interest expense. so they claim their contribution profit is $18,000 per house. In my opinion, it's only fair to include the interest expense, because they need to borrow money to buy the houses, and the more houses they buy, the more they have to borrow. Traditional realtors tend to have strong connections in their local communities. They acquire new customers through word of mouth, attending community events, and things of that nature. As an online-only platform, Opendoor does not have these advantages. This obliges them to spend heavily on advertising. In the first quarter of 2025, Opendoor spent approximately $52 million on marketing. This equates to almost $18,000 for each house they sold. That's far in excess of the $8,200 contribution profit they made per house. Throughout 2021, Opendoor rapidly expanded. They were flush with cash from their recent SPAC merger, so they expanded into new markets and ran expansive marketing campaigns. Their revenue peaked in the first quarter of 2021 at more than $5 billion. However, they've been consistently unprofitable. In the orange bars, I have their operating profit minus property finance expense. On this metric, they've only been profitable in one quarter. In the first quarter of 2022, they eked out a profit of $60 million. The only reason they made a profit is because during the quarter, home prices across the US increased significantly. Remember that it takes a few months for Opendoor to sell each house. If home prices are rising in general, this benefits them. In the second half of 2022, home prices declined, and Opendoor reported a massive loss. Throughout 2023 and 2024, US home prices increased modestly. Despite this, Opendoor reported losses every quarter. In an attempt to decrease their losses, Opendoor has exited some markets and become far more selective in their home purchases. Back in 2022, they were selling more than 10,000 houses per quarter. This has now decreased to around 3,000. We've laid the foundation of why Opendoor struggled over the past few years, and why their stock price declined 95%. Now let's listen to the bull case from Eric Jackson.
They have high revenue, but the market doesn't think they'll ever be profitable. This quarter, which they're going to report in a couple of weeks, they've already sort of hinted that it's going to be their first EBITDA positive quarter in something like 3 years. And so the thing is, like, can they get to steady state profitability? I think they can. And if they can, that's when investors are going to do the same thing they did with Carvana. And they're going to say, well, I guess we were too bearish. I guess we got to recalibrate here. What's a good forward multiple to apply to this company? And I think, 5x is reasonable. If you go out to 29, it's, they're supposed to do $12 billion of revenue that year. That's the Bloomberg, consensus number. If you pull it up on the terminal, that's how you get to smack $82 a share. If you kind of back out the debt and the cash and you look at the share count and all that kind of stuff.
Let's unpack what he said. Currently, Opendoor has a very low price to sales multiple. This is because the company is losing money. Jackson thinks the company will become profitable. Once the company becomes profitable, Jackson expects the price to sales multiple to increase to 5. He also expects Opendoor's revenue to more than double by 2029. This gets him to an $82 price target. Opendoor indeed provided guidance saying they expect to report adjusted EBITDA of between $10 and $20 million in the second quarter. Adjusted EBITDA excludes stock-based compensation, which is expected to be approximately $15 million. So they're guiding for their real EBITDA to be barely break-even. EBITDA does not take into account interest expense. They accrue roughly $30 million of interest expense per quarter from the money that they borrowed to buy the houses in the first place. So even if they break even on EBITDA, they'll still report a net loss. Maybe we're just splitting hairs by looking at the interest expense instead of just the EBITDA. But there's a more fundamental problem with Jackson's bull case. He says Opendoor will reach steady state profitability in the second quarter. But even if they do report a profit in the second quarter, there's nothing steady about the current state. The only reason Opendoor's profitability is improving is because they're increasing their buy-sell spread. In other words, they're only making lowball offers. Obviously, if they only make lowball offers, less people are going to accept these offers. As a result, Opendoor only expects to purchase 1,700 homes in the second quarter. This is a massive decrease from the 3,600 homes they bought in the first quarter. This will result in a decrease in sales in the second half of the year because they won't have as many homes to sell. Eric Jackson is trying to have his cake and eat it too. He says the profitability will improve and the revenue will increase. But the only way to increase profitability is to make lowball offers, which will result in lower revenue down the line. Opendoor itself says this. Despite the poor quality of Jackson's analysis, he has garnered more than 60,000 followers on Twitter. He incessantly tweets memes about Opendoor, including an AI-generated picture of Donald Trump holding an Opendoor stock certificate. Many of Jackson's Twitter followers are retail investors who have piled into Opendoor's stock. As of Tuesday, July 22nd, Opendoor was the single most mentioned stock on the investing forum StockTwits. The third most mentioned Twitter was a cryptocurrency called Based Chad. That gives you an idea of what type of people are active on StockTwits. So what is Eric Jackson's background, and why do so many retail investors follow his advice? Prior to 2016, he was a stock market commentator. He wrote articles for financial publications including The Street and Forbes, where he would talk about stocks. In 2016, an unknown billionaire noticed his articles and liked what he read, so he contacted Jackson, offering to give him some money to start a fund. That's how Jackson started his hedge fund, which he named EMJ Capital. He mostly invested in speculative growth stocks, following a similar investment strategy to Cathie Wood. Up until 2021, his performance was stellar. One of his long positions was the online used car retailer Carvana. Let's listen to a short clip of Jackson talking about Carvana in May of 2022.
I think the most controversial name on your list and what has become one of the most in the market itself is Carvana. Why Carvana now?
Everyone loves to hate Carvana. This stock is amazing. It went down 75% from last summer till the end of 2021. And then it's gone down another 75% this year. Everyone hates it. They think they can't make money. That, a lot of people are as bearish on it as they were bearish on Tesla, saying it's going to go bankrupt. The fact is, though, similar to Amazon back in the day, they've invested in a huge infrastructure for their used cars. They can, through that platform, they're going to sell more used cars in the future when they figure this out. They're going to sell new cars. They're going to sell fleet management. They will be around.
2022 was a bad year for Carvana. By January of 2023, its share price fell to as low as $4. The company was losing huge amounts of money and was burdened with a massive debt load. At the time, we actually posted a video about Carvana. We speculated that the company may soon face bankruptcy. 2022 was a disastrous year for Eric Jackson. It wasn't just Carvana. Most of his portfolio was concentrated in speculative money-losing companies. These were the stocks that got hit the hardest during the 2022 bear market. It got so bad that his billionaire benefactor lost confidence and pulled out all of his money. As a result, EMJ Capital lost 99.5% of its assets under management overnight. Against all odds, Carvana secured emergency funding and its business started to recover. Over the following 2.5 years, Carvana's stock price surged almost 100-fold from its lows. Jackson maintained his Carvana position, so benefited from this rally. However, he was starting from a very small base. He says EMJ Capital still only manages a few $1 million, despite his massive Carvana gains. On Twitter, Eric Jackson describes himself as the Carvana hedge fund guy. All he does is try to find the next Carvana. Now he's saying Opendoor is the next Carvana. On the surface, Opendoor does seem to share a lot of similarities with Carvana. Carvana buys and sells used cars from consumers. They buy used cars for a cheaper price and sell them for a higher price. Both companies fund their operations with large amounts of debt. However, there are also a few key differences. Carvana gives lowball offers just like Opendoor. Maybe your used car is worth $10,000 and Carvana gives you a $9,000 offer. You might be willing to make this sacrifice for the convenience of getting an instant quote online and not needing to haggle over the price. Used car salesmen are notoriously sleazy and won't hesitate to rip you off. If you understand the value of your car and are good at negotiating, you might be able to get a better price than Carvana. But it's also possible that you end up getting an even worse deal. The home selling process is very different. You hire a realtor who works for you. Your realtor is incentivized to get you the best possible price because their commission is a percentage of the sale price. It is true that you have to pay a large commission to the realtor, but the fees charged by Opendoor are even higher. For most people, their home is their most valuable asset by far. If you have a mortgage, the value of your home may even be greater than your net worth. When selling your house, you have hundreds of thousands of dollars on the line. It is well known that Opendoor gives lowball offers that are typically tens of thousands of dollars below market value. Very few people are so impatient that they are willing to sacrifice so much money just to save a few weeks or months. Because of the poor value proposition, Opendoor is obliged to spend exorbitantly on marketing, and it still remains a very niche offering. Eric Jackson got lucky with Carvana. This has given him credibility among many retail investors. By saying Opendoor is the next Carvana, he was able to catalyze a meme rally. But this does not change any of the fundamental problems faced by the company. I do not expect this to end well for Eric Jackson or his followers. Alright guys, that wraps it up for this video. What do you think about Opendoor? Let us know in the comments section below. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.